What is your sense about how this is going to play out in real time when we're talking about the possibility of another auction? Yeah.
Well, it's a monumental auction. So when it happens so quickly, the FDIC knows what it's doing. Bankers know what to do when they have an asset, but it's complicated. So you couldn't do it really in a day. The real thing that's going on here is that most loan officers love their loans and they think they're above average, and then the buyer comes in and they don't think so. So I think there's a massive gap of expectations. So that has to be settled. Maybe they have to give them more information. It will take some more time. It's a very interesting bank. I know there's some really good buyers looking at it. And if not, it will be broken into pieces because it's got, like I said, some very good assets.
Does this put mark-to-market accounting, does that just thrust it into the forefront now where banking is concerned? And if so, what does that mean in terms of how other companies would be valuing the assets here? And I guess just as importantly, what are the lessons learned from 2008 when we saw big banks swoop in and buy other banks and then take on all those liabilities and maybe pay the price later?
Gosh, there's a lot in that question. But, there's $300 billion of mark-to-market and held to maturity that's like tucked away. And the problem is it's going to have to be resolved. We haven't even hit a credit crisis. So the carrot of the Fed coming in and saying all the CDs are covered above $250,000 and they have a $25 billion stabilization fund they can use, that's all great. But the stick is that it's only 1 year. So there's a lot of work to do, or we're going to be sitting right back here again. So you're going to see a lot of offers, a lot of restructurings, a lot of asset liability rearrangement. Means a lot of different trading. You're going to see a lot of trading action in the markets as people move these securities around. And then you might see some stuff that bankers are doing, like risk transfer deals, where specialists who maybe know a particular kind of portfolio come in and work with the bank and then say, we'll share some of this risk. A lot better than a panic sale like we saw the other day.
Okay, Burke, I got a non-bank M&A question for you, but it's adjacent to this story. Is the collapse of SVB going to force a repricing of Silicon Valley startups?
Oh, well, at some point, and I've had some talks with VCs over the weekend, they're thinking about how hard they need to be on their portfolio companies. Is it I guess you could say, whose fault was this? And so, but they need another round of capital. So they're deciding on valuation. So yes, they could have down rounds, but they're trying to be as fair as they can. So that's, I think, going on. The second thing that we saw over the weekend is one of our deal makers was doing a deal, and in the midst of it, there was a tens of millions of dollars difference in valuation because one side was saying, well, that money is at Silicon Valley Bank. It's zero. And the other side was saying, oh, it's full. It's par. On Saturday, it was a zero. And on Sunday, it was par. So you can imagine the fun and games over the weekend.
In terms of the banks, the regional banks sector more broadly, I mean, the KRE hit its lowest level since November of 2020. The financial sector in general taking another drubbing today. Is the expectation that we're going to see more M&A activity across the board in light of what we've just seen take place with not one but three banks failing over the past week?
Yes, we have to first get out of this situation where there's no confidence whatsoever. So you're going to have some intrepid people, and I think the government may have to do something. I'm not asking them to because I like the fact that it's going to try to be privately solved. We don't need a TARP. We can do this. The question will be, how that occurs. So I think some M&A, some people just throw the towel in. I mean, even before this, a lot of banks were saying, I can't keep up with the technology investment. There's a whole bunch of things they have to do to now have to deal with deposit runoffs and what it's going to do to margins, because if they try to keep the deposits, they got to raise the rates. That means it will cut their margins right down to practically nil. So what do? Maybe you just sell.
So it sounds like we're in the early innings in terms of what's going on in the sector more broadly. We hope you will come back and keep us updated as all of this plays out. Burke Dempsey, thanks for joining us.